Welcome to the deep dive. I'm really excited about what we're getting into today. We're going deep on airport food and lounge services, focusing on a key Indian player, Travel Food Services Limited, or TFS. Our main source is their recent IPO note, which gives us this amazing inside look. So our mission today is to give you the essentials on a company right at the center of India's massive travel boom. We'll unpack their business model, their strategy, what makes them tick, and we'll look at the bigger picture too, the market dynamics shaping travel and hospitality. Just so you know, the IPO itself is running July 7th to July 9th, 2025, so this is all very current information we're working with.
Absolutely. And an IPO note, well, it's more than just paperwork. Think of it like a company's biography and business plan rolled into one. It lays out the operations, the financials, where they see themselves going, and crucially, the whole market they operate in. It's a really valuable window.
Okay, so let's unpack this. Who is Travel Food Services? They started back in 2007, and their core identity. They're an Indian airport travel quick service restaurant, QSR, and lounge company.
Right, and travel QSR is a bit different, isn't it? It's not just any fast food. It's really about curated F&B concepts designed for speed and convenience, specifically for travelers who are, often in a rush.
And the scale is quite something. As of March 31st, 2025, they had 442 total travel QSRs. That breaks down to 384 outlets in 13 Indian airports, 29 outlets in 2 Malaysian airports, and another 29 on Indian highways at 9 different sites. Operationally, it's interesting, 270 QSRs they run themselves directly. The other 172 are through associates and joint ventures, JVs, and their total reach, including lounges, covers 14 airports in India, 3 in Malaysia, and 1 in Hong Kong.
That's quite a footprint. And that mix of direct operations and JVs, it suggests a pretty smart approach to growing and managing risk in different markets, sort of a flexible strategy.
All right, let's talk brands because they have a lot. As of March 31st, 2025, 127 F&B brands in total, and it's a real mix. 32 international brands, 58 Indian brands, and 37 they've developed in-house. We're talking big international names: KFC, Pizza Hut, Jamie Oliver's Pizzeria, Krispy Kreme, Third Wave Coffee, plus well-known Indian ones like Bombay Brasserie, the Irish House. And their own brands are visible too, like Cappuccino, Dilly Street, Idoli.com. Seems like they cover a lot of bases.
Yeah, and the model behind it is interesting. They use franchise agreements, pay royalties, and for some partners, Subway, KFC, Pizza Hut, they actually set prices with the brand. What's fascinating here is this blend, isn't it? Familiar global giants alongside local Indian tastes and their own creations. It's a smart way to cater to, well, basically everyone traveling.
Okay, but it's not just food. The lounge business is a big piece too. They had 37 lounges as of March 31st, 2025, 28 in India, 8 in Malaysia, 1 in Hong Kong. And again, it's a mix. 13 run directly, the others through JVs and associates. Who uses these lounges? Well, first, and business class folks, obviously. Airline loyalty members, people with certain credit or debit cards, and sometimes just walk-in customers.
And strategically, they're expanding their own Araya Lounge brand into the Middle East and Southeast Asia via subsidiaries, which is interesting because their promoter, SSP Group, focuses elsewhere: Europe, Australia, North America, and New Zealand. It kind of raises a question, doesn't it, about how they've carved up the world map to maximize reach without stepping on each other's toes, a clear division of territories.
So how do they actually get these prime spots in airports and on highways? It comes down to long-term concession agreements. They bid for these for the QSR units and the lounges. As of March 31st, 2025, they held 70 concessions. The average length is about 8.2 years, with around 6 years remaining on average. That's quite a commitment in a place like an airport.
It is, and what's really impressive is their track record of keeping those spots. Their contract retention rate. Since 2009, for airport concessions that expired, it's an amazing 93.9%. They either renewed or won them back. Plus, that big win in February 2024, the Noida Airport F&B and lounge concession for 10 years. If we connect this to the bigger picture, well, it signals really strong operator relationships and, frankly, that they know what they're doing in a tough market.
They've also got key strategic partnerships bolstering their position, like with Delhi International Airport Ltd for Terminal 3 and a JV, GMR Hospitality Ltd with GMR Airports covering places like Goa and Hyderabad. There's another JV too, Semolina Kitchens PVT Ltd with the Dani Airport Holdings and AJ Holding, though the stake there is down to about 25% now, apparently due to a business model shift. Okay, here's where it gets really interesting for a lot of people, the financials and the IPO details. So the IPO dates again, July 7th to 9th, 2025. Price band 45 to 1100. Issue size is 2,000 crore and it's entirely an offer for sale OFS. That means existing shareholders are selling, the company isn't raising fresh capital itself. At the top end of the price band, the implied market cap post-issue is around 14,485 crore. And the PE ratio based on FY25 earnings is 38.2x, which is definitely pricing in some significant future growth. Now, looking at the performance highlights, the growth trajectory is pretty clear. Revenue from operations went from the 167 crore in FY23 up to 1,396 crore in FY24, and then 1,688 crore in FY25. Quite a jump.
EBITDA, that's earnings before interest, taxes, depreciation, amortization, a key profit measure. It was 374 crore in FY23, then 412 crore in FY24, hitting 554 crore in FY25. And net profit, the bottom line, 251 crore in FY23, 298 crore in FY24, and 380 crore in FY25.
Yeah, those numbers show really consistent growth year on year. It seems to be accelerating. Points to strong financial health and operational efficiency. The profit jump is particularly noticeable.
Let's break down that FY25 revenue of 1,688 crore. 52% came from the travel QSR side, 45% from lounge services, and the remaining 3% from management and other services. And within travel QSR, which was 872 crore total, it's almost an even split. 54% from partner brands, 46% from their own in-house brands.
That's a really interesting split. It shows nicely diversified streams and that near 50-50 balance in QSR between partner and in-house brands. That suggests a well-thought-out strategy. They get the pull of the global names, but also build their own potentially higher-margin brands. It's balanced.
Okay, now to really get why TFS is in such a potentially strong position, we need to zoom out. Look at the Indian travel market itself. It's not just growing, it feels like it's exploding, right? And government initiatives are a huge part of that. The union budget for 2025-26 put $25.4 billion into tourism. That's way up from the $8.5 billion revised estimate for FY25. Plus, you've got plans boosting connectivity, new destinations, opening more airports.
Exactly, and that translates directly into infrastructure. The number of operational airports jumped from 102 in FY19 to 135 in FY24.
Yeah.
And they expect another 35 new airports by FY29. That's basically creating more storefronts for companies like TFS.
And the passenger numbers are just staggering. India's the third largest globally for air traffic now, and projected to be the fastest growing. Look at the growth rates. FY15 to FY25 saw domestic traffic grow about 9% CAGR, international about 4%. Going forward to FY34, they expect domestic to keep growing around 9% and international around 7%.
This just underscores the massive sustained demand that's powering this whole sector, doesn't it? I mean, that kind of passenger growth provides a constantly expanding customer base for airport services. It's fundamental.
Now, let's look specifically at the airport retail market, F&B, duty-free, all that stuff. It's expected to grow about 15% between FY24 and FY34. But here's a really telling comparison. Globally, airports make about $15 from aeronautical revenue and $12 from non-aeronautical per passenger. In India, it's just $3 aeronautical and $4 non-aeronautical. So what does this all mean? That gap seems huge.
It is huge. And it's not just about money. It implies a difference in how people use airports in India compared to globally, or at least how they have historically. The real insight here is how companies like TFS, with their specific brand mix and lounge offerings, are perfectly placed to capture that potential upside. As flying becomes more common, as the middle class grows, that non-aeronautical spend, things like food and shopping, has enormous room to grow. They're positioned to cultivate those spending habits.
Drilling down even more. The Indian travel QSR market grew around 16% from FY19 to FY25 estimate, expected to grow maybe 18% from FY25 to FY34, and airport lounges, even faster, grew about 24% from FY19-25E and expected to grow around 23% from FY25-34. The number of lounges is set to jump too, from 90 in FY24 to maybe 160 by FY34. Think about it. London Heathrow has 33 lounges. Mumbai, Delhi, Bengaluru, they have maybe 8 to 10 each right now.
What's fascinating there is that direct comparison. It really highlights the untapped potential, particularly in the lounge segment in India. We're nowhere near the density you see in mature markets. So there's just so much room for expansion as traveler expectations evolve.
And a key driver for lounge traffic, you mentioned cards earlier. About 70-80% of lounge access comes via credit or debit cards. And card penetration in India is just rocketing, FY25. 99 crore debit cards, 11 crore credit cards by FY34. Projections are 110 crore debit and a whopping 34 crore credit cards. Triple the credit cards.
Right. And that directly fuels lounge demand, doesn't it?
Yeah.
More premium cards in circulation means more people eligible for lounge access, often as a built-in perk. It's a major factor behind that projected lounge growth.
So where does TFS fit in all this market growth? Their market share is pretty strong, around 30% in airport lounges by volume. If you include their JVs and associates, it's more like 45% based on lounge revenue. In travel QSR, again including JVs and associates, they had about a 26% market share in FY25. Of course, there are other players. Devyani International is listed. Unlisted ones include HMS Host Services, Light Bite Foods, and Calm Hospitality, Sapajiri Restaurant. It's a competitive space.
But here's a really significant competitive edge for airport players like TFS. Airport travel QSRs generally have higher margins, maybe 5% higher EBITDA margins, and significantly higher average daily sales, like 15–20% higher than comparable high street QSR. A lot of that comes down to the airport environment itself. Captive audience, more single orders, willingness to pay for convenience. And if you compare TFS's margins 32.8% EBITDA, 22.5% PAT in FY25 to, say, Devyani International's 16.4% EBITDA and slightly negative PAT, well, it shows TFS's efficiency in this specific airport niche is really impressive.
That profitability difference is stark. But could Devyani's broader focus, maybe less airport-centric, explain some of that? Is it a fair comparison? Or what else drives TFS's efficiency?
That's a fair question. Devyani definitely has a wider scope. But I think the data really points to the inherent advantages of the airport segment itself. Higher potential spend per customer, captive audience, etc. TFS seems to have really honed their model to maximize those specific airport advantages. Their focus likely allows for operational tuning staffing, supply chain, menu optimization that's just perfectly suited to that environment, leading to better conversion of revenue to profit.
So summing up the sector out, like, you've got surging passenger numbers, better airports, people spending more time and money in them. Plus, it's a tough market to just jump into, right? High barriers to entry security, complex contracts, high costs. That tends to favor the established players, like TFS. Okay, but no deep dive is complete without looking at the potential bumps in the road. Risks and roadblocks. A key one has to be the reliance on those concession agreements. Around 20% of their current agreements expire in the next 3 years. That brings risks, doesn't it? Renewal isn't guaranteed, terms could change for the worse, or they could even be terminated early.
Absolutely. And those agreements themselves can be quite restrictive. They often dictate things like the type of food and drinks offered, price points, required capital spending. Airport operators might even have the right to move them or temporarily shut them down. So non-compliance or just unfavorable changes in those terms could definitely hit the business, impacting margins or requiring unexpected costs.
And then there's the reliance on partner brands. We saw that was about 54% of their travel QSR revenue in FY25. So the risk is if they can't keep those partners happy or attract new ones, that's a big chunk of revenue tied to external relationships.
And layered on top of all that is the regulatory environment. It's extensive. Airport and highway operations, security rules, obviously food safety, health, environmental regulations. Any slip-ups in compliance or even just changes in the rules could negatively affect operations, potentially leading to fines or disruptions.
This raises an important question for me. What about government initiatives like the Udaan Yatri Cafe? These offer really basic, affordable food options in airports. Could that actually draw customers away from TFS outlets, especially people just looking for the cheapest option? Could it impact their sales?
That's a really valid point to consider. The Udaan cafes target a specific value-driven segment. While TSS caters broadly, these cafes could certainly carve out a niche, potentially taking some volume from the lower end of TFS's customer base. It might force TFS to differentiate even more strongly on their premium offerings, their brands, and the overall experience. But, while these risks are real and need managing, they're pretty typical for this kind of business. Operating in airports, dealing with concessions, regulations, it comes with the territory.
Right. So we've covered a lot of ground today. We've really dug into Travel Food Services Limited. We've seen their significant footprint, their robust model across India's booming airport QSR and lounge scene, backed by solid financials and smart partnerships.
Yeah, stepping back, they seem remarkably well placed. It's a high-growth industry, but one with high barriers to entry, which benefits them. And it's all underpinned by these powerful trends of increasing travel and spending in India. It's quite a story.
So wrapping up, here's something for you to think about. As someone interested in where travel, consumer habits, and the business of convenience all meet, what does this all mean? With Indian air travel continuing its steep climb and how people use airports evolving, what new opportunities or maybe challenges do you see ahead for companies like TFS? Will that non-aeronautical spend gap close even faster than predicted? Or will those value options gain more traction? Lots to watch in this space. Keep pondering that until our next deep dive.